Well, I think the sort of industry initially tried to ignore it, I think, and it's only when it got to about last autumn of last year when we found certainly clients focusing on the issue, because obviously July is getting that much nearer. I think there's still a lot of uncertainties as to how the AIFMD will apply in different cases. Indeed, what is an AIF? There's an exemption, for example, for joint ventures, but no one knows what constitutes a joint venture for this purpose. There's issues about whether gearing at the AIF level, gearing tests are looked at the AIF, or whether you look at the gearing at the underlying vehicle level. There's a whole series of different things which people are still looking at, and indeed some of the transitional exemptions aren't clear in their application. So I think clients are really doing an analysis to see to what extent their funds will be subject to the regime or not. And if they are, then working out what changes they need to make to their management practices inter alia to try and they have to keep risk management, what's called hierarchically and functionally separate from investment management. But quite often we find that the funds aren't called, either because there's grandfathering provisions for funds that have made all their investments by July 2013, or funds that have raised their money in 2011 and will be wound up by 2016. So there's quite a lot of grandfathering funds that will be excluded. And a lot of funds, certainly in the UK for tax purposes, have a model where there's a non-resident entity, possibly in the Channel Islands or somewhere, with a UK advisor, which works very well for tax purposes. And that model takes you out of AIFM because you've got the UK registered entity is not a manager, it's just an advisor, and the decisions for tax purposes are made offshore in a non-EU jurisdiction. In terms of new funds, we find clients, there was initially a concern, would you need to be AIFMD compliant to raise equity? And the general view seems to be that that's not an issue at the moment. In fact, investors are more concerned about the increased cost of complying with AIFM and how it's going to impact on returns. So quite often we find in new funds, people try to structure them to try and take themselves outside AIFMD so far as possible.
So in terms of the funding side, do you think there's a significant impact there, or not really?
Well, no, it's definitely a material impact on the industry, and it makes some very important changes in terms of requiring depositories for each fund, risk management, valuation, remuneration, and sort of transparency and reporting, etc. So there's definitely a significant impact. And in general terms, the larger fund managers are likely to do better than the smaller fund managers. I think there's a view that it could lead to more consolidation in the industry because the smaller fund managers won't be able to accommodate the cost with the same sort of economies of scale. So it's certainly significant, but equally I think the industry is trying to adopt as pragmatic a view as possible to the changes. And certainly I think a lot of our clients, who include a number of institutional fund managers, are all consistently adopting the approach of doing as little as possible. And one of the drivers of that is really just looking to do the minimum, and if there's an area of interpretation where you could take a more relaxed view of something because it's just unclear, then they're tending towards that side of the fence. And it's partly because the EU themselves said that the whole AIFMD will be reviewed in a couple of years' time. So you could change all your models and investment practices to try and accommodate the current rules and then find 2 years later it's changed.